viewer mail time.
We have viewer mail?
And we have some mail.
Well, that's great. If you would like to send a question, please send it to doug@riskandrewardtv.org. I would be happy to answer your questions. Better answering your questions than mine. What do we have this week?
Okay, this is from Mark in Ann Arbor, Michigan.
I think he's our number one viewer. Mark, I think you're our number one viewer. Thank you so much, Mark. Love Michigan. Did you know Michigan's got a hand? And you just
I
okay.
know, you told me before.
Okay.
Okay, so here he says, I understand the market general volatility, but what causes the market to be down 600 points one day, up 400 points day 2, down 500 day 3, then up 400 points day 4? Talk about volatility.
Yeah, it's bouncing all over the place. Yeah.
Market news hasn't changed that quickly, so why has the Dow?
Well, good question. Excellent question, Mark. I'm sure a lot of people are interested in this. I'll give you my take on it. So first of all, markets are driven by many, many factors. Mostly it's fear and greed in emotions in situations like this. What's happening here, you say, you asked about the news hasn't changed so quickly. That's because these markets aren't being driven by news. They're being driven by traders. Not investors looking to invest in a long-term position, but traders trying to make a buck in and out. Traders love these markets.
Oh, yes.
They're making huge money because they'll get in and out, and they're just trying to pick the next top and bottom, and they make a lot of money doing this if they time it right. Some of them lose a lot of money too, but they're trying to get in and get out and trade, which is why they just keep pushing down the trades on the downside and raising up on the upside, because the traders aren't scared. They have more volatility the more money they make.
Yeah, the VIX really spiked. It's up to 40 right now, so volatility is huge.
And it can continue. You know, the VIX is the volatility index. It measures, I won't get into what it measures, but anyway, it's a measure of volatility, how much the market's bouncing up and down. It was over 40 for 131 days in the crisis. I don't remember, it was 2008. I think it was 2008.
So back to 40 again.
Yeah, so it's back to 40 again. It might stay there for a while. So now think about this in terms of technical analysis versus fundamental analysis. Fundamental analysis is people looking for net present values of future cash flows and figuring out what a company's worth. And then they invest on it when it's a little down and so on. A lot of good deals out there if you follow fundamental analysis. Technical analysis follows the trend. So they're looking at the market bouncing like this in a trading range, and it breaks through the trading range, they immediately go and push it down further. Or if it breaks on the upside, they immediately buy because they think it's going to go up further. So there's a lot of people just trading on technical analysis only. And so when you think about why markets move, it's why people are making these decisions.
Now talk about high frequency and program trading.
Well, that's a good point, because these aren't just individuals doing this. These are machines doing this.
Computers are taking
right.
over.
The T3, the rise of the machines, is here, right? So the machine trading can be good or bad. They usually come in the beginning of the day and leave at the end of the day because they don't want them running all night. They don't want to have a risky position overnight. So you'll see, in fact, you notice if you follow the market really closely, you'll see in the morning there was a couple of days where it opened high and then all of a sudden sold off huge. And it stayed huge the rest of the day. At the end, it kind of picked up a little bit. A lot of the times the computers are trading on algorithms or program trading that says, you know, if the market's going down X percent, get out or short it more. Or at the end of the day, it's like, okay, we've made some money now, come in and buy the market and cover your positions. So a lot of trading happens at the beginning and the end of the day, and it's because the programs, the computers are coming on. Now, there's one of the things.
What about Europe? And they're banning short.
Well, they're banning short selling. So
shorts.
Exactly. So they're banning all shorts right now. So short selling is a very important factor in the market. So we talked about this before. Long is buying a stock and holding on to it. Short is selling a stock. In the future, you'll buy it back to cover your position. Well, if you're going to go short, which you can do now anytime you want, you go short, you sell 100 shares of Cisco, and 2 days later you buy the 100 shares back. Well, if this price went down, you made money. Well, if the price goes the opposite of where you want it to go, the only way to close your position is to buy the shares. So
at the higher price.
At the higher price. So if you bought Cisco at say 13, I don't know what it was, 13.63 I think, but let's say you bought it at $14, and they come out with earnings and everything's good, and the market was down 500. You bought it at $14. You think that you shorted it at $14. You think it's going down further. All of a sudden they come out with earnings and they blow away earnings, and everybody thinks, oh well, Cisco's good. And the next day everything's going up. Well, if you shorted it, the only thing you can do the next morning is to buy it higher.
Yes.
And you and everybody else who
loss.
shorted it already are buying it in the morning, which just makes that move bigger. So it's called covering your shorts, which is not necessarily the nicest term in the markets, but when you cover your shorts, or when there's a short covering rally, which is probably a nicer way to say it. The short covering rally is mean that everybody sold to push, and that pushed the market down. Well, now if you're the first one out, that's great. If you're the last one out, everybody else has to cover their position as the price starts to rise, and prices get high. There's more volatility. There's more movement in the prices because of that. So, and the news is still big. I don't want to discount all the news. One little move from the German chancellor in the wrong direction will send this market down 500 points. So if Angela Merkel sneezes, we're going to feel it.
And they're still on vacation right now.
And they're on
gonna be
vacation.
coming back
She's
and making
hiking
lots of
in the
decisions.
Italian Alps.
On her cell phone, though.
On her cell phone, but she's hiking in the Italian Alps. So there was a report that said she hikes like she governs. She takes it one step at a time, and she's very methodical. And I'm like, I don't want to know she's hiking in the Italian Alps. I want her home working on her problem. Okay. Anyway, enough about Miss Merkel.
What's your take?
My takeaway is markets are driven by emotions, and when events and emotions run high, decisions aren't made on the fundamentals. The difference between I'm going to make a killing or I'm getting killed can change in the blink of an eye, and that's how fast market prices can change in volatile times. Thanks for the question, Mark.